yeah, to feel that. So I was actually laughing looking at this photo on the screen at the moment because I'm in a white shirt, and there we go, transition. And the funny thing is, I was just having a quick late breakfast just before the webinar, and it was chili scramble with prawns in it, and I was trying to get one of the prawn tails off, and it went all over my shirt. So not that white one, this one I'm wearing, which is a bit damp at the moment, but at least it is always dangerous. I didn't know how dangerous.
Always a risk, and never eat spaghetti when you're wearing white shirts as well. So,
all righty. On that note, before we get stuck into the topic that we're here for, I do want to share some upcoming webinars and workshops that we're hosting. Okay, so the first one here is the Cashed Up workshop. I know it's short notice, but we've had it in the calendar for weeks now. We're hosting the Cashed Up workshop tomorrow, and Rose is actually going to post the link in if anyone wants to register. It's 9 a.m. for 2 hours. There's a few seats left, and it is online. So similar format to what we're doing today. We just get a bit more drawery with workbooks and the iPad in front of me, so it's a bit more interactive from that perspective. But yeah, if you do want to come along, please book in using that link. The next one we've got, this is one where, how do you say, quite a few of our clients and people sort of exploring to work with us actually have this problem. And it's a really, I don't know, it's a really nerdy thing, I think, a really accountancy thing to talk about. But it's one of the most annoying things that our larger clients experience, which is all around solving this whole problem with company loans. And if you've had that experience and an accountant has used accounting language with you, the phrase there is Division 7A. So we're hosting a webinar. We've got some, what we're going to share is some pitfalls of the really common things that we see clients and prospects use, but also some really long-term strategies. So, we don't want sort of short-term band-aids or fixes with this stuff, and it can catch up on you. Like this issue can, if you don't keep it in check, it can catch you out after a while. But so we're going to be sharing that long-term stuff. Oh, wow. Sandy, there you go. Just made my day. I was blindsided by Division 7A by a past accountant. There you go. So we'll be definitely covering, especially those long-term solutions. So, and it's just about playing your investments and how you take out money out of your business a little bit more planned than maybe previously. So, cool. That one's good. And the link for that one, Rose has also posted in the chat box. Now, next one. Now, this is actually a related one to the topic we're talking about now, because actually a lot of the topic today is talking about self-managed super funds and really getting the most out of them. Yes, it's commercial property, but a lot of our clients use their self-managed super funds to get that sorted. So we are actually hosting a webinar series in October. So we don't have all the details at the moment, but there is a link to register if you are keen to be updated on that one and learn a little bit more about getting the most out of your SMSF. We will be covering property a little bit, but it's going into many other things around super.
I love the name as well, Ben. SMSF Millionaire. It's a very attractive name.
That's it. It is. No, it definitely is. And what I've kind of observed with clients is that, once they start focusing on this stuff and getting a bit of an investment strategy around it and focus on their super, not running a business of it necessarily or full-time dedication to it, but, just sort some stuff out, get a plan in place. You can quickly see some, tens of thousands or hundreds of thousands quickly accumulate in super, which is very...
Yeah, and it's kind of like a prevalent thing in Australia as well. If you ever paid taxes, I'm sure you guys do, you'll see where your taxes actually go. One of the big bills is age pension, and in Australia we have an aging population that do not have enough for retirement. So a big thing is there's a big push about giving concessions to self-managed super funds and using them well to grow that retirement fund for yourself. So the government doesn't have to kind of foot the bill. So it's an interesting space for us to work in, but also for business owners, especially businesses who are just starting, or they're on the younger side of the age spectrum. That's usually the last thing on their mind. I don't want to be thinking about retirement. I'm busy with my business. There's a way that we can do this that we'll see it through today. Actually, it complements your business. It doesn't have to take away from your business.
Absolutely. And it's not just necessarily property. We've helped clients fund businesses, new ventures, business partnerships using funds from super, which is, I mean, there's a lot of detail to that, but they're just so powerful. And they even blow my mind. And we were talking Riz earlier this week about a situation where I was like, wow, that, learning something new about it every week. So yeah, they're fantastic. All right. So, and just before we get into it, I do want to mention as well, if you have to take off a bit earlier, we do have an opportunity. If you do want to consider working with us, feel free to jump on a phone call with one of our accounting team. Rose is going to post in the chat box a link to book in a strategy call. At 20 minutes, you can debrief from this webinar, questions around self-managed super, buying property, whatever, or just looking to potentially get a touch more proactive accountant. So there's an opportunity to do that. Just a bit of an introduction. I can see plenty of familiar names in the attendees, but there's also a few people I don't know. So I'm going to do a quick intro to myself, and then I'll get Riz to run through your introduction. And P.S. I added a line, by the way. So, yeah, my name is Ben Walker. I've got a wife, Stevie, and a son and daughter, Rose and Ezra, and it's the other way around. Rose is my daughter. Ezra is my son. I started Inspire at 23, and we have saved our clients over $13 million in tax and counting, which is one of the reasons that drives what we do here. And also through our partnership with B1G1, we've given 13 million, or more than that, 30 million days of impact to families in need around the world.
It's quite amazing, hey Ben, how they rack up over the years, and sometimes you just don't take a second to think about that, but that's a pretty amazing outcome.
Absolutely. And I would like everyone to meet Riz.
Yeah, and some of you might have already met me before, but if you haven't, my name's Riz. It's actually short for Rizal, and I'm originally from Malaysia and moved here to Australia to kind of kickstart my education and career. So I've been with Inspire for about 7 years now, and during that time I was lucky enough to meet my now very beautiful wife. I hope she's watching, with a sausage dog that we have, little Penny. So yeah, I've been working with Inspire for 7 years, working as a general manager and a chartered accountant servicing our clients here. We actually have a few of my clients online right now. Nice to see you guys. And yeah, it's been an amazing transition from where I was before. I've been working, previously I was working with a lot of the larger businesses and doing in-house accounting for them, just making sure their books are up to scratch. But I realized that I want to do something more meaningful and more impactful, and I found Inspire back in 2016. And proud to say that, in 2020 we had a fairly big year in terms of tax savings. That was the year that's just the tax savings itself, not necessarily the help that we gave out, but it was over $3 million in tax that we were able to save our clients. That's just within my team, but also even on top of that, there's things like JobKeeper, cash flow boost that we were able to help our clients with as well. So yeah, really proud to share that number. That's something that I wake up, the reason why I wake up and come to work every day. So yeah, it's really nice to meet you guys and nice to see everyone again.
Wonderful. All righty. Well, I'll run through a little bit of what we are going to cover. So we're going to cover roughly sort of 4 things. The first one is the structures that we use for clients to purchase property. That's the first one. So like companies, trusts, super funds, how do we do it? The next one is lending options. And that kind of ties in with the first one. I mean, this all flows through together, but lending we'll cover a little bit on. Self-managed super funds, ins and outs. So because we rely on them quite heavily with clients and their purchases, we're going to share a little bit more broader stuff on self-managed super, and also 5 case studies. So I think we've got 5 that we've kind of looked at our clients and what sort of worked well, why have they done certain things, and just share some anonymous, high-level numbers and stuff. So cool. And also a little bit about why are we sharing. So why are we sharing? I'll cover first, and then I'll cover why are we sharing now in a moment. But why are we sharing this stuff? I've personally been an SMSF member since 2011, so that's coming up probably about 10 years this year. I've looked after like hundreds of SMSFs over my career. So I was lucky enough to start when I started in KPMG. I actually started in a role which also covered some superannuation, some SMSF audits. So I've actually seen since 2007, like how this stuff works. And even at my role before starting Inspire, it was very heavily geared into SMSFs to grow people's wealth. 60% of Inspire's SMSF clients hold some sort of property. And we are an advisor. Sorry, I'm an advisor. Riz is. Our accounting team is an advisor on many purchases and restructures. So when we get a client looking to buy something, we usually have a quick meeting of the best way, throw ideas around and how to do that. And roughly 28% of our clients have a self-managed super fund. So that's a bit of a background into our experience with it.
And there's also that personal side of things where that's where I think you get a lot of knowledge and also expertise, is the practical side of things, where you're a member of a self-managed super fund, and I think your family is too.
I'm a member of two self-managed super funds.
AKA your inheritance is in the self-managed super fund, isn't it?
Maybe
if you behave.
That's it. That's the hardest bit. Alrighty. And then why are we sharing now? Couple of thoughts on that. And this topic kind of, we had a few people asking around this stuff. And firstly, COVID's knocked us all around, in whatever way. I don't think anyone's sort of not been thrown off a bit. Some businesses still rely on physical premises. There's just like some people can work from home, may work from home for the foreseeable future, but there's some businesses where you do need to be seen face to face. And like an obvious example of that is medical treatment, or even paramedical, allied health, that sort of thing. So other businesses don't rely on premises, which has dropped supply of tenants. So what we saw pretty early on in COVID is a lot of people weren't going to their premises. They didn't need it. They're working from home, and you've got landlords here with half rent or a portion of the rent they used to receive, or no tenant at all. So there's a drop in supply of tenants, which means it's actually, I believe it's a great buyer market for commercial, not necessarily residential. But commercial property seems to be, if you need it, a great opportunity to purchase at the moment. All righty. Now, Riz, would you like to walk us through the different structures of, and what I've done with this slide is kind of covered all the structures we might use. And then right at the bottom, you can see like what we actually use out of the four options there. So, it's just walk us through.
Yeah, and I guess, without kind of going each and every one of them into the crazy nuances of each structure, at the top you see the different shapes that we use here. Inspire. The first one is in your own name, or as a sole trader or individual. Second one is a company, trust, and then a self-managed super fund. Now, there's kind of four things that we kind of look at in terms of, three things that we look at here. One is being the tax rate. Now, if you're an individual, you can pay up to 47% in tax on. Yeah, it's a bracket kind of level, but the top level is at 47%. So it starts getting a little bit painful. Nearly half of your money goes to the ATO. And you got the company where there's two different tax rates. You pay a flat tax rate of 26% or 30%, depending on how big your business is. More often than not, it's at 26%. Or if you have passive investments, it's in that 30% bracket. And then you have the trust where you pay 0% tax. A lot of people see that and go, whoa, let's trade through a trust. Not necessarily. What it means is the trust is like a funnel. It doesn't pay a tax on its own. What it does, it distributes that to the beneficiaries, which could be a sole trader or individual or a company. So you end up paying either 47% of tax, or 26 or 30%. Now, here's what we're here for as well. Self-managed super fund, 50% or zero. What a self-managed super fund is established for, the sole purpose is for your retirement. Now, kind of circling back to the age pension issue that we have in Australia, they really give them some massive concessions when it comes to super. So if you have investments in super and you make money there, before you retire, you pay 15% on all the income in that self-managed super fund. Once you retire, it's tax-free. Although it might still chug along and still make that income. The difference is that once you're retired, they don't want to clip you any more money. They want you to get tax-free income from your pension. So big concessions there. So you can see how that can be attractive as well. Now, there's another level here, which is, it's kind of part of the same thing. It's tax, but rather tax concession. So without going into too much detail about CGT and its rules, one of the major concessions that we have is a 50% CGT discount. So if you sell a property, you make 100 grand capital gain. If you held for more than 12 months, you get a 50% capital gains discount. You might have heard of this before. Now, you get it as an individual. You don't get it as a company. You do get it as a trust and a self-managed super fund as well. And the next one here is about what we use kind of in terms of the structures for property. So typically we don't like using individuals or companies here, where we kind of drive more of buying your commercial properties in trust and self-managed fund. The reason why is you can see the green ticks and also the flexibility that we have in terms of tax planning. But something that's not kind of included here or shown here, with a trust and self-managed super fund, you can also effectively plan your asset protection strategies as well within your family. As a self-managed super fund is fairly protected. That's one of the big benefits. If you ever go bankrupt, or if you ever, if people were trying to come after your assets for whatever reason, your super fund will be well protected. So that's something that's worth mentioning as well right now, because you could own your commercial property outside of super. Yep, definitely. But it is technically at a higher risk compared to your super as well, just by way that, your super is meant for your retirement and they want to protect that as much as possible. But yeah, that's kind of the gist of it. What I like about the super fund with is the tax environment. If you compare all the structures overall, the self-managed super fund always has one of the best tax environments. It's paying 15% or 0%, which is great. You still get your capital gains discount. And if you retire and you have all these properties and portfolios of shares or whatever that you invest in your self-managed super fund, you can start liquidating them and not worry about losing that capital as well to the tax man. So really, really attractive.
Yeah. And it depends on like the rules around that 0% tax rate have got more complex in the last sort of 3-4 years. But like if you made hundreds of thousands of dollars worth of gain, and you meet those conditions, that's literally like zero tax at all compared to the company of losing a third of it, or a trust, or distributing it to an individual where you still lose at least a good quarter of it. So yeah, they are fantastic. Now we do have a question that's come through, which is a lovely segue.
It's Spanish, Ben.
It sounds very Spanish.
Segue.
What and the question is, why would we buy in a trust? But I've categorized that as outside super because we do have a client or two, and they've sort of been taken on board from previous advice, but they do sometimes own them in their own name or a company name. But for the context here is, why would we buy outside super versus inside super? So what I'll do is run through some superannuation. I will just mention as well, for the whole legal disclaimer-y bit, we don't really love that stuff, but I am a registered mortgage broker. I don't write loans. We kind of refer that out, but I did the study to learn this stuff and to become a better advisor around this. So I know this through experience and study, and happy to take questions on it. But if you do need help, we would be referring you to someone who's well versed in this stuff and can actually write the loan. So yeah, outside super, it's slightly less complex lending, and I'll cover what the lending looks like in super. That'll take actually quite a few slides to do that. There's a higher tax outcome, so we just spoke about that. There's just higher tax rates outside of super. That's a con of doing it outside of super. Business personal income can be used to service, and you might need that to be able to purchase the property you want to do. You can adjust for existing rent. So what I mean by there is if you're paying 80K in rent to a third party at the moment, and you're looking to buy a premises to, like a new premises to take over that lease, we can actually add that 80 grand back to your income. So the bank looks at your looks at that and sort of adjusts for your actual rent in your new property. If it's only 50K, for instance, in the new property you're buying, that will help your borrowing capacity. The next one there is you can use other security for deposit. So that's unique about outside super. And one of the restrictions of lending inside super is the opposite of that. So inside super, the first one there is LRBA. Now that is an acronym for Limited Recourse Borrowing Arrangement. So the reason why there's a fancy borrowing thing in super is because super funds on their own can't really lend money from a bank or anything. They're not supposed to lend in their own right. There's rules where you, and I'll explain this shortly because I'll go into a bit of detail on it, where in the right conditions, if you've got the right trust set up and the right loan agreements and they meet the requirements of the SIS Act or the Superannuation Act, then you can actually borrow using funds with your super and receive the income into your super fund. So you can do it. That's a short way of saying what I just said. Next one here is super contributions. So the ones you make as an employee or as a business owner, whether they're from the business or personal contributions, they can count towards your servicing of your borrowing capacity in your super fund. So if you're dropping between you and your spouse, if you're dropping 55 grand a year in there, plus the rental income of your prospective property, that's going to do wonders for your borrowing capacity. But if you're only chipping in, $5 a year in contributions, you're only going to be relying on rent. And the lenders in this space need to see a little bit of consistency. So there's one who looks at the last 2 financial years, including the one we're in. So you can just dump, 50 grand in now. And that's how they look at it. But yeah, you do need a bit of history if you need contributions to service. And unless it's a really high yielding property, you will probably need your super contributions or a low loan. That's the other way to look at it. We covered tax 15% or 0%. There's very few lenders. So there's 2 main ones. And I hear rumors that there's a couple of others who still do it. They just don't advertise it. And they might do it for their, call it their private clients or that sort of thing. I say very few lenders, but I don't want that to scare people. It's actually quite simple. I've never seen one being declined. Do that. The broker does their homework and make sure it adds up before you go and submit an application. But I've never seen one knocked back. And the form, I think I've got it down here, or maybe a bit later. The form to apply for a limited recourse, crazy technical borrowing arrangement is less than the one to go and buy a home. It's incredible. So, and the reason for that is it's covered by different legislation. You don't get the consumer protection when you buy a home that you do if you're buying commercial, especially in super. So that's the reason why. It's typically a higher rate, not silly, and it also depends on how much loan you get as a percentage of the value of your property. So if you've got a higher deposit for your property, you're going to pay less on the interest rate. You need a cash deposit, so you can't borrow equity from another property, even if it's owned if you've got a property already in super, you can't redraw on that property to put a deposit on another one, like you can outside of super. So that may be a limitation. I did have a client who bought their first property in super and then focused on paying down that debt, wanted to buy a second one, but they didn't have cash and they couldn't redraw because they didn't know that they actually couldn't redraw again on that property. So if you do have a property already in super, just be aware of that. If you're looking for multiple purchases, you cannot cross collateralize or access the equity there. And then you cannot borrow for construction costs unless it's off the plan. So the whole idea there is that you, with SMSF lending, you can only have one loan for one asset. And with house and land purchases, or even if you're building a facility, you can't borrow money for the land and then borrow for the construction of the whatever you're building on it. So there's two ways to do it. You can borrow for the land and then pay cash for the construction, or the other alternative is you buy it off the plan, where you've got one contract from a developer, and you pay for the land and the construction in one contract. So that is some notes on lending inside super. Now, in terms of both can owner occupy. I didn't add here specifically commercial property, but that is the condition. So you cannot owner occupy a residential purchase in super, but you can owner occupy commercial in outside or inside super. We can also see LVRs go up to 80% inside or outside. And I think I've got more on that in another slide. I'll just see there's a couple of questions that come in. So Stuart's asked, buy a factory facility through your SMSF and mortgage will be in your SMSF name. Kind of. It's a touch more technical than that, but that's the idea. Then the rent paid monthly by the tenant, which is potentially yourself, on the facility, and it will go in to service the loan, and any additional rent money will then go into your SMSF to further increase its value. Yes, or pay the outgoings of the property, or buy shares, diversify in other asset classes. Yes. So I don't know whether your note there, Stuart, was a question, but it was more just clarifying the understanding, but you are correct there.
Cool.
All righty. Next one here, deposit required. Just sort of further building on what we just spoke about. The deposit required depends on the lender. It also depends on the postcode that you're buying in. So if you're buying in Whoop Whoop, then it's probably not going to be a high LVR that they'll lend. And so there's some no-go postcodes as well. The asset type. So is it a office, a warehouse, is it standalone freehold or part of a strata title? The price of it too. If the higher the price, the higher the risk to the bank or lender, they might loan you less. But as a guide, I usually say go 30% plus stamp duty, and then be surprised if they'll lend you 80% value. So you may need 20% plus stamp duty on the lower end. But 30% plus stamp to be safe. If you're sort of back of the napkin working out how much you might have in super versus what you could buy. But we've seen bank lenders not go above 60% lend. So you'd need a 40% deposit. Again, it's just a guide, that one there. SMSF sometimes need 10% of the value of the property in liquid cash. So some lenders require, let's say you buy $1 million property, they'll want 100 grand in your bank account after settlement. So you actually need, let's say, 30% deposit plus stamp duty plus an additional 10% in cash afterwards. So again, it's so much depending on what the deal is. Abdul has asked, does the deposit for the property have to come from existing cash in your super only, or can you make personal contributions on top? You can absolutely make personal contributions as well. And so keeping in mind, you've got your 27.5 grand at the moment per year of tax deductible contributions you can make. They're called concessional contributions. And then you've got, is it still 100K, Riz?
110.
There we go. Thought it gone up. 110K in non-concessional contributions. So that is the after-tax contributions.
And it's worth mentioning as well, right? Like, that's a great question, Abdul, because we look at the structures we went through, we kind of just picked up the SMSF and started talking about it. And that's the reason for it, is because if you ask the question, how do you buy your commercial property or your business premises? Usually, if you have the money outside already, you would already do it. And this is kind of like looking at that, unlocking that the capital that you already have that you probably haven't looked at. And this is just putting that as an option, that as your super balance is something that you could consider if you wanted to. And this is where the deposit, where do I find a deposit? Exactly right. There's a balance in super, but if you have money outside and the property that you're looking to buy is a little bit more expensive, you need a bit more deposit to get that 30% plus stamp, then contribute into it. And that 27 and a half concessional and 110 is something that you can move into super in 1 year if you wanted to do that. The ATO actually released recently, well, not recently, maybe a year or so ago, that you can use unused super contributions from the past as well. So if you never contributed into super in the past, I think it was from 2019, you can use those caps, those 25,000 cap 2019, 2020, another 25,000. You can bring that forward. They're called the unused super contribution caps, and use it in 1 year. And then they brought another rule in called the bring forward rule for the 110,000 that you can put in. So you can actually bring forward 3 years worth of 110,000. So that's 330,000 that you can put in. Now, with that, kind of adding it all up, that's a lot that you can, if you did have the cash outside that you wanted to invest in your super fund, you could move fairly quickly if you do have a property in mind, or if you're already renting in one, plus the balance that is in your super fund.
Yep. And just an asterisk on what Riz just said there, you got to have the right balance in there, the right age and all that sort of stuff. So don't just go and dump 400K in the super fund and think that's all right. You just, please get advice before you.
Definitely talk to your accountants. There's a lot of little landmines that you have to be careful about when it comes to self-managed super funds.
There is. Yep. All right. Stuart's asked, can a business also make these contributions? So they can make the concessional contributions as an employer, sponsored contribution or salary sacrifice. But you'd have to make non-concessional contributions from your personal cash. So again, Stuart, we can talk more about that if you're keen to take some cash out of the business into super. But that's the short answer. All righty, we will keep moving through. So we had a question. So one of the questions one of the things we ask before we do a webinar is, do you have any questions? One of them was, what is the buying process, which I wouldn't have normally sort of showed, but we actually put that together. So thank you to whoever popped that question in. And there's a stressful way to do it, but this is probably the less stressful way. And the first step is to get pre-approval or some idea that you can buy what you're looking to buy. That's sort of step one. Now, if it's Inspire Super, if it's inside Super, you don't necessarily need your SMSF already set up. So you could be looking but not have an SMSF. And I'll kind of clarify what the stressful part of all that is in a moment. Outside Super, it's simpler than a home loan, in my opinion, to get pre-approval or for a commercial property. Set up SMS. So the next step after pre-approval, if you've found somewhere, a property, is set up an SMSF and a bare trust, or set up a trust, whichever structure you're using. Now, remember how we said we only use SMSFs or trusts. That's why it's a set up an SMSF or a trust. So that's one or two. Now, the bare trust is the lending vehicle, and I'll share a little bit more about that on the next slide about the bare trust. But the lead time is 1 to 2 months to be safe. So what we want to make sure is that when you're looking to buy something, you need your structure set up to be able to sign the contract in the right name. But the lead time on actually getting your existing super, if you don't currently have an SMSF, can take days. We set up an SMSF, have a signing meeting, open the bank account, client puts in the forms, and quickest we've kind of seen is maybe 1 to 2 weeks. That is like so rare. Self-managed super funds industry super funds are getting a lot better but there's still ones who make it difficult to take your super away, because the sooner you do that, the less fees they get. Maybe that's
and I guess to double down on that point, it's the setup of the SMSF and the paperwork itself wouldn't take long for you to sign it, but that's just a skeleton. What really takes time is trying to get that money that is yours out of the industry super fund. And if you do make that decision, you want to pull that out, that industry super fund needs to be comfortable that that money doesn't go to your secret bank account that you just go to Vegas with. So they want to make sure that it goes to a compliant super fund. They want to make sure that it's in the right name. There's all this check and balances that they have to do before they release that. So that's the one that takes the longest. Yeah. So I guess the point of that is if you found a property and it's a hot property market, you got to take this into account. You might lose out on property just because you haven't got your ducks in a row. So if it's going to take some time and you're already ready to do all this stuff, get in touch with your accountant first and make sure that that gets done as soon as possible. Not, hey, I'm going to auction tomorrow. That likely won't happen, unfortunately.
Yeah. Yep. And the other thing as well, like we can apply for an ABN the day after the SMSF is set up, or even the same day, but the ATO has up to 28 days to get that paperwork out. So if they don't get that ABN until 4 weeks' time, then only then we can apply to the SMSF for the rollover. So, and then they've got 28 days legally to respond. So you can see it can take 2 months pretty quickly. So yeah, Stephen Burrows. You must be in the financial industry, mate. So is it a requirement or an option to have a statement of advice from a certified financial planner at this stage before moving forward? It is not necessarily a requirement. So it's up to the client whether they want to seek advice or just ask for a self-managed super fund to be set up. Awesome.
I guess to kind of drill down on that, it really is. There's a lot that's been put in place to make sure that you make the right decisions and you get the right advice. And I just want to say that there is a lot of cowboys in this space or cowgirls in this space where we're playing with people's retirements here. So you want to make sure that the people that you do work with is trusted people and give you right advice as well. Now, if you've made the decision to invest in that commercial property on your own standing and you know the risk and you're going to take it anyways, that's up to you. But always, if you don't know what you're doing, get advice if you need to. That's not something that's seen as bad or anything. You just want to make sure that that's done right. So that's kind of where Stephen's coming from. Do you need to do it? It really comes down to you and your risk profile and where you want to go with that.
Yeah, absolutely. Cool. And then the alternative, so we've got 1 to 2 months lead time, and then the other one is set up a trust, shorter lead time, as there's no rollovers or third parties to sort of work through. I mean, yes, you still need an ABN for that. But the trust is a bit more simpler. But again, you need that entity set up to sign the contract. So and again, you can negotiate settlement times if you do need those extra couple of months. Now, fund property. Now, the next step after that is funding the property and making an offer subject to finance. That is always a very good idea. So you want to make sure you've got your approval. And if you don't, then have a finance clause in there. We're not lawyers, but it's just common sense. And then apply for finance. If accepted, go through to settlement at the end. So that is kind of the buying process. Or who asked that one?
Yeah. Well, you read that question, man. And if you look at from top to bottom, it's all about getting your ducks in a row. And depending on the structure, some has a lead time, some doesn't. So yeah, my advice is always get your ducks in a row as quickly as possible or as early as possible. If you know you're in the market, you're looking already, and you're ready because you got the capital, it doesn't mean that you get to access that immediately, or you need to make sure that it's in the right places. So when its settlement comes, you're not having to extend and risk losing that property as well. So yeah, this is just less stressful if you talk about it earlier. So if you're not even in the market, you're looking to get in the market, talk to your accountant on how to get your ducks in a row first, because you want to be ready to pull the trigger when you find the right one.
Yes, awesome. All right. Now, what have we got? We've got a little bit more on SMSF borrowing. So the LRBA, this is what I touched on earlier, limited recourse borrowing arrangement. There's a few spelling errors in these slides. Sorry, I handwrote them and someone's transcribed them. But the SMSF cannot just buy a property with lending attached. So we need this little intermediary called a bear trust. And that bear is spelt correctly. It's not the bear as in the animal. But the bear trust sits in the middle as almost like a shadow purchasing entity. You can borrow from a bank, but you can also borrow from an entity that you control as well. So if you've got a spare cash in a bucket company doing nothing, you could actually lend that using the right paperwork and everything to your own self-managed super fund to then purchase a property. We just need to make sure it's all at market value to make sure we don't have any problems with audit or breaches of the superannuation laws there. But it can be done if you've got some excess cash outside. And we've got a case study on how that worked. It was a really a great outcome for one of our clients. All right. Another question, just to clarify, if it's an existing factory, can part of the loan be used to build out specified areas, or is that only an option for buying a factory off the plan? So Crystal, yeah, you couldn't have a purchase loan, a loan for the purchase and then a loan for the construction. You would have to fund the whatever you're doing, whether it's an extension or renovations. You'd have to fund that with cash, and unless, yeah, and I can't think of an example where you'd get one contract for the both of that. So yeah, that might be a bit tricky.
Well, what about fit outs, man?
Yeah, fit outs. So there's a couple of ways to do that. We've got a case study coming up where the client actually paid for a couple of things. So he paid for the furniture from his business. He prepaid rent to the super fund for, call it a year, and then the super fund used that cash to go and do the fit out as well. So I mean, there's a million ways to do this. So it's almost like working out what you want to get, what you want to achieve, and then we kind of workshop how it might work from a cash flow perspective.
It is all very different in every situation.
It is. And Crystal, yes, cash from within the super fund already, or as I said, you can look to contribute more, pay rent, a few different ways. SMSF ins and outs. So other SMSF options, buying outright, in brackets, no loan. So it's really simple to buy a property outright with cash. You don't need LRBAs or a bear trust. Yeah, it's quite simple. Another option is buying outright inside and outside of super. So there is a structure that we use, a certain type of trust we can set up where there can't be any loans on the property, but you can use some money from super and some money from outside super. So that might work where you don't want to borrow necessarily money from a lender or a bank in super, and you've got some cash outside of super and you want to go 50-50. In this example, it's 2/3, 1/3, super, non-super, but we can look to do something like that. Again, a complex structure, different to an LRBA. And then another one here, buying it in a suit. So you need 2 or more business partners for this one. And a suit is a different type of trust we use as well. And this one can borrow money. Yeah, another very complex one. But again, tell us what you want to achieve, who's involved, where the cash is currently, and then we can workshop potential outcomes for this. Now, another question that came through, and I think Steve Burrows will be happy about this slide. We've got the sort of general prices for what we charge or what we sort of see with SMSFs. Now, the first one is a setup. Now, we charge $3,000 plus GST for a setup of an SMSF. That does not include advice. We used to offer advice to our clients. We had a limited license, financial services license. And every time we offered, we always got knocked back, apart from twice in about 5 years. So we've actually removed our license because we've actually haven't had the use for it. And so therefore we don't currently offer advice to clients on whether they should set up a self-managed super fund or not. So I do want to be very clear about that. And then the ongoing administration and accounting is $250 a month, or it's from $250 a month. Now, it is more if you've got pensions, more than 2 members, heaps of asset classes, but most of our clients pay that $250 a month. That includes BAS for commercial properties, administration, ESA, which is an electronic service address. It's a requirement of self-managed super funds now, where your payroll will send information to our Smsf software if we're looking after you, to connect it all up with the ATO. Financials, tax returns, online portal where you can log in and see your balances, and Smsf support. So like any of our packages at Inspire, we don't charge for those quick phone calls, quick questions. If you are looking to have a strategy discussion around purchasing, with one of this stuff, we might have an initial chat with you, but if you want full on, structure setups and things like that, obviously that's additional. And in terms of other things to keep in mind, so $350 or so for the annual audit, that's just reimbursed from a third party auditor. Also $3,000 to $5,000 for optional, not optimal advice to advise on the setup. So again, that's what Stephen Burrows asked about is if clients do want advice on whether they should, then that is an option. We don't offer that, but we can point you in the right direction of an advisor who can. The next one is around about the $3,000 mark for a bear trust setup. Sorry about that line across the bottom, but if you do need that lending vehicle, so you've already got an SMSF, but you want to set up one of these lending vehicles, the bear trust, to enter into an LRBA, then that is our price to set those structures up. Alrighty, hope that is helpful. Cool. And Liz, I might just leave your question. I can see it there, but I might just leave that towards the end. So we've got 5 case studies. And again, feel free to pop questions in the chat box or the Q&A box. We're monitoring both there. But Riz, one of your clients, would you run us through the vet from the bush?
Yeah, sure. So this is a great case study because it had a long-term kind of impact on the business and their personal wealth as well. So we had this vet from the bush who came to us and said, hey, I have a property that I hold outside of super. It's about 300K. And there's kind of like a loan outstanding of 150K, which is a pretty good loan balance at 50% of the value of the property, right? And you say, but I just want to get rid of it, and I just want to get move forward. I know I have enough wealth inside and outside of super to do this. So how can you kind of re-strategize the way I hold this commercial property? Because he runs and this commercial property that he has, his vet practice actually runs in that is renting that commercial property. So he has that business. Yeah, like an owner occupier. Yep. And essentially, what we did was we moved the property that was held outside of super. So he held it. Can't remember now if it was personally or in a trust, but somewhere outside a super. And then he paid stamp duty on the transfer. Now, the beautiful thing is he had enough money to pay out that loan within super. So when he moved that, what happened was he paid out the loan and also paid out the transaction costs like super as well. Now, what happened as well is he had a lot of money outside of super that he needed to clear that loan as well. So he lent the remaining money to his SMSF. Now, this is an important bit. I'm just going to slow down here. First, we moved the property in there. Now there's a loan outstanding. He paid some of that loan off. Now, how he got the extra fund into his self-managed super fund was actually to lend from his personal self to the self-managed super fund. So it's kind of like in a way, it's kind of like a vendor finance because the owner outside of super, which is himself, lent that money into super. Now, what that means is in that self-managed super fund, he owned the property, but he owed the money to himself outside of super. Okay, so it just means that now he's purchased the property in the super fund, but he still owes money out of super. Now, that's an important bit to understand. It's key to the strategies because what he was able to do was as he earned rental income on that property or as he made super contributions into the self-managed super fund, meaning that the super fund is making more and more income, what he could do is actually repay himself, or i.e. the vendor, back that money that was borrowed in the first instance to buy that property. This is key because when you put money into super, usually what happens is, everyone knows this, is you can't touch it till you retire. The benefit of doing this transaction is that he was able to clear his loan, but also get some money back out to himself. So outside of super, while he's still relatively young, he could still regain access to that capital that was moved into super essentially. So that last bit there, yeah. So he owes his SMSF owes him 150K for the purchase, and he pays 27.5K in super contributions and obviously market rent into his self-managed super fund as a tax deduction. That's another thing that's worth mentioning as well. And he takes it back out through that 150K loan, and that's a tax-free loan repayment back to him. Now, yes, it earned a little bit of interest on that loan, but it wasn't massive. At the end of the day, what we were able to do is move this commercial property into the super fund, clear the loan out, but also get back the capital outside of super as well, which is all quite magical over time.
Wonderful. And that client's pretty happy with you?
Oh, yeah. Talks about it all the time. Now we're getting more vets from the bush, I guess.
Awesome. All righty. Now, this is actually one of Inspire's relatively first SMSF clients. So this case study is from quite a few years ago, but one I remember clearly. So there was a commercial property owned outside of super, around about $1 million in value. The client was shifting into retirement. He wanted to move money and cash and assets into super. And so he had an LRBA with a bank. So he moved this property in for $1 million purchase. Yep, cool. Decided to move in, and the super fund borrowed from the bank. He wasn't an owner occupier, so it was just a pure investment property, commercial property. But he received a rent for a few years at 0% tax because he met the retirement conditions and all that sort of thing. And after about 2 to 3 years, he received an offer to buy the property for 1.3 mil. And because he was retired on that 0% tax rate, paid no tax on that 300 grand gain. So also keep in mind that if he bought this commercial property at $500,000 outside of super, and it was worth $1 million when he transferred it in, he's actually got to pay CGT on the transfer and stamp duty. So keep that in mind. There is transaction costs to it, so we've got to weigh up pros and cons there. But in this instance, yeah, he made a $300,000 gain, roughly tax-free. I mean, all of these are anonymous and rough numbers for obvious reasons, but yeah, that was a fantastic outcome for that client. And I think that basically doubled his super fund in 2 or 3 years. It was incredible.
Yeah, and there's a timing thing as well with all of this stuff. Like if you're close to retirement, them moving, they want to move more of their wealth into super because it's a way better tax environment once they retire as well.
Yeah. Cool. And we've got the next one here. IT business in Melbourne. So I helped it out with this one. This was actually a COVID thing. So the business was previously renting and had grown through COVID, so more people. The owner had an opportunity to buy near his home, purchase price around 300. Property needed fit out, which was funded through prepaid rent through the business. So I mentioned earlier, this client needed a couple of partition walls and a few bits and pieces fit out wise. And so he actually prepaid 12 months rent, and the super fund used that cash to do that sort of minor fit out work. The fittings and furniture were paid for the business itself to access instant asset write-off. So yeah, the desks, the chairs, all that sort of stuff, the business paid for, and the client now paying similar rent, but to himself. So then ideally he'll carry the capital uplift of that property as well over the years. Alrighty, now not your client, Riz, but you might know of him. Do you want me to go through this? Because I do know the situation.
Yeah. Okay. Maybe you run through this one.
Yep. Awesome. Thanks, Stuart. Saw your note. So a home office to premises. So service business in the building industry has grown through COVID. the existing home office hitting its limit and a bit uncomfortable with the baby on the way. Client purchased an 800K property, so not 180, 800K property, around 75% LVR, needed renovations, funded in super fund from cash, furniture paid for by business for the instant asset write-offs, the same as the previous example. And then the client now has a lovely shop front to take him into the next stage of his business's growth. Pretty cool.
Well, what's great about this is I love the part that you put about the baby on the way. Usually some people feel a little bit trapped in terms of like where you can go next, and this is kind of what we do is it's showing you some possible options that you can look at to make sure that you don't feel like, oh, I just have to keep what I'm doing, and keep renting or keep working at home, and there are other ways that you can achieve an outcome for your family as well. So yeah, it's worth diving into and looking into it if it's not something that you've thought about or you've only just started thinking about.
Awesome. Abdul's asked if you need more than 1 year's worth of rent for the fit out, can you pay for more? There's a couple of complications with that. As a small business, you can only pay up to 12 months of prepay, 12 months of expenses, and claim it as a tax deduction. So we've got to be careful on that front. And then we've also got to be careful on making sure it's all market rate. So, we do see third parties prepay rent from time to time. But if you're going to pay 4 years rent, that might be like, just a little bit less arm's length. So
what I would look at there, Abdul, is other ways as well. There's more than one way to get more money into super as well. So like we mentioned earlier, the super contribution levels, unless that's fully exhausted, then it might take some time. And this is the other reason why as well, in terms of timing or setup, if you're looking at balance and you're looking at the cash that you have available, you need to almost plan that going forward, because there is limits in how quickly we can get money into super. And these limits mean that you might have to do it over 2 years rather than all in 1 year. So there is a bit more lead time when it comes to planning if you don't have that much capital just yet as well. So that's another scenario you have to think about as well.
Cool. All righty. And our last one, Riz, you've advised on this one.
I actually don't remember.
Okay,
wait, hold on. Okay, so there was 4 business partners. Okay, so they were looking to buy an office space. What I like about this is the 4 business partners. They're a good bunch of blokes, and all of them had self-managed super funds. And they set it up. And what they had to do was actually buy this commercial property together with all their self-managed super funds. What's different about this scenario is the 4 business partners and having 4 different kind of sources of capital. So if you guys have business partners or you have people that would, you guys are always, obviously you have to be good at working together with, you're going to own property together here. But if you guys trust each other and you have a good working relationship and you want to go into a commercial property, it's definitely possible with a self-managed super fund as well. So what they did was they took 200K each to put the deposit down and purchase a 750K also property, including kind of the transaction costs and everything as well. So how we did this is through what we call an ungeared unit trust. So it was fully cash funded. I'm going to be clear that it's an ungeared unit trust. It's kind of like buying it outright, but the only reason why they could is because there was enough funds from 4 different people. So you're not playing the game alone. You're getting a bit of help from your business partners. They each of them own the 25% through the of the property through the unit trust, which means that it doesn't own directly through the so the self-managed fund doesn't own it directly. It owns units in the unit trust, which owns the property. There's another level there. That unit trust is important, and this trust essentially owns it outright. So the benefit of that is every time the rent comes through, it gets split 25% each way, and if they sell that property, any capital gains made is then split up each way as well. Something worth kind of considering there as well. If it's a kind of mixed bag of partners, you will have different people having different benefits coming from this. What I mean by that is, I think in this situation, those 4 business partners, out of the 4, 2 of them were retired, which meant that if they make a capital gain or they make a rental income from there, when it comes to their super fund, it's all tax-free. Which is pretty amazing. The other 2, not yet, a little bit on the younger end, but it's just worth considering that as well, because if you want to chat about it, different people have different benefits depending on their situation.
Cool. All right. Thank you for that, Riz. I can see there's a question there, but I just want to, just given time, I want to just quickly wrap up, and then we can
go to Q&A.
Go to Q&A. Yep. Just another reminder as well for people who join a bit later. We are offering a strategy call with an account if you do want to debrief from what we talked about on the webinar. Or you're just looking to look into switching to a more proactive accountant. And then a few of the events we've got coming up. We've got Become an SMSF Millionaire. So that's late October. The links are coming through in the chat box. Rose, that was just sent straight to me, so we might have to resend that one. But the upcoming webinar, 20th of October, it's a very closely related topic to what we've spoken about today. Cashed Up Workshop. This one is actually tomorrow morning, so a very short amount of lead time on it, but we've had it in our calendars for a couple of weeks now. We are kicking off at 9 a.m. It's a 2-hour workshop all about establishing a profit war chest, getting a grasp on the numbers, and then also stop giving half your profits to the tax man. So a lot of tax saving strategies in that one. And then the last one to run through is the Division 7A, solving Division 7A or company loans problem. So again, a bit of a nerdy one, but one that I think a lot of people need to hear and see if they can improve on their situation. Cool. So yeah, we're going to stay for 5-10 minutes, as we usually do after our webinars, to take questions. I can see 2 so far. Liz, you did ask a little while ago. So can my husband roll over super balance to an SMSF and wife leave hers in an industry super fund for diversification? That's possible. It's absolutely possible. But another suggestion is that you could potentially get the same diversification by rolling the wife's into the SMSF and investing in a similar asset class or classes or investments as to what it was in the industry super fund. So that's a suggestion and what we see people do when they do want that diversification.
But you can also be a member of 2 super funds as well. You don't have to be you don't have to be one or the other. So Liz, you still could be a member. I'm assuming this is your husband you're talking about. But yeah, you can be a member with your husband in the super fund, but only his super is rolled over. Then he buys property in there. The benefit of that is you can choose to still contribute into that super fund if you wanted to from any other excess profit that you did have outside of super. So yeah, it's not one or the other. You can be both as well.
Yeah, good. And then Kyle's has asked, are there any benefits to putting your kids into the SMSF? We don't see this too often. We've got maybe 3 or 4 clients. So that's not a very big percentage at all with kids in the fund. Now, you just got to be quite careful. And the reasons are there's implications if a member dies, is divorced, or is disabled. I think the 3 Ds. So if your child, for instance, has a relationship breakdown and you've used their super to go and buy property, which is not too liquid, and they need access to that money to pay a marriage settlement, it can get quite tricky. So again, like it's just arming yourself with the knowledge around the complexity of adding the kids in. But you can, again, you can do a lot of things. It's just, just being aware of what the potential downsides are.
Yeah, and I just want to, I wasn't laughing because of the 3 Ds. Nothing to laugh about that one. I was more laughing if we had a scenario where you become estranged with the kids as well, and issues of kind of managing the super together. Because when you're members, what you're essentially doing is you're becoming, because it's super fun, it's a trust. And how you control the trust is the trustees have to act and make sure that they sign off on things as well. So they are one of the people that could make decisions as well. So it's just something that, yeah, I guess if you're not on the same life stage, you need to just be aware of that. If it's different life stages that you're at.
Yep, absolutely. Sandy said, had so much trouble with accountants and finally found someone I trust. Thank you. With that in mind, can I talk to you just about setting up an SMSF and have that run separately to other business with other accountant. Again, you can. There is a bit of a downside though, because if we're not seeing the big picture or the full picture, then we lose that sort of really proactive approach that we take. So again, maybe we can have a chat more about why you'd like to sort of separate the two out. But again, open for that conversation. Abdul, Rick, thank you.
Thanks, Rick.
Thank you for that. See you later.
Thanks for the little feedback as well.
Abdul, if you haven't got big deposits to purchase property, can you use your SMSFs in shares? Anyway, hang on, I'll read that again. If you haven't got big deposits to purchase property, can you use your SMSFs to invest in shares? Yes, you can. Yeah, SMSFs can invest in shares, manage funds, Bitcoin, cash, term deposits, property, commercial, residential. There's heaps of stuff you can do with it. And again, like, working with our clients with SMSFs, we, if you've got questions saying, hey, I've got 100 grand in the account, I want to buy property in 2 years, but can I do this, this, and this in the meantime? We would say probably in most cases, yes, you can, or hey, no, that's a breach, or okay, maybe do it this way. And then you just need to make sure your investment strategy of the super fund matches what it's invested into. So yeah, again, that's a detail on the compliance side of running an SMSF, is you have to have an investment strategy match what you're invested in.
Absolutely. Thanks, Lisa. If you're still here, thanks for joining us as usual.
Thanks, Elisa. Cool.
Okay. Yep. Sure. No worries, Lisa. I'll get in touch. Okay.
Wonderful. All righty.
Cool. See if there's any more. Is there any more through the Q&A?
No more questions I can see.
Yeah. And I guess if there's anything that you have, as you can see, the reason why we use case studies in this scenario is it is you can do it in so many different ways, and it really comes down to your situation and how kind of your little nuances with your kind of your financial position and also your structure as well. But it's not impossible. It's just about planning it right, getting it right, and executing that plan together. So if you want to have that conversation with us, booking that strategy call, that's something that we can work together on. But yeah.
Wunderbar. Well,
Wunderbar. Spanish and German today, Ben. Very well.
Yeah. All righty. Well, that looks like the questions that have come in. Again, if you're a client working with us, just feel free to reach out to me or the accountant that you work with at Inspire if you do want to have a bit of a debrief on anything you've learnt today. And again, if you're not working with us, but you're inspired to do that, maybe Sandy.
Inspired to, good one.
And then feel free to book in for that strategy call, and then we can work through that way. But yeah, I love this stuff. This is probably my favorite webinar in the last few weeks or months. And I can talk for ages on it. So thank you very much for, as Riz could attest to, thanks for joining.